G'day folks, welcome back to another update for natural gas, and the charts are showing a continuation of a downtrend, so all the prices are continuing to slide. We're going to include some back testing in the analysis today. Now, I recently posted a video today comparing three strategies, the CCI14, the CCI1500 and the Heiken Ashi is the new one I added to the table of results. So links in the description below, so follow that video after this one. I'll go through the deeper dive into the concept and what we're approaching here as well. In terms of the outlook as of today, July 23rd, natural gas spot futures, US production is robust at around 116 BCF. Inventories are now near 5-year averages, but sluggish global storage injections and surging LNG exports. US EIA forecast at $3.70 and to $4 MBBTU for 2025-26. Point to tightening fundamentals supported by summer demand and pipeline constraints. Macro backdrop, increased LNG export infrastructure, example Appalachia pipelines, power generation, data centers, AI hubs and emerging Asia appetite are all bolstering gas demand, while infrastructure bottlenecks and regulatory delays persist. So looking at the natural gas long-term trends first, we always do that. We've got the price here, and that's still bullish above the moving averages. Although notice a couple of things, the CCI1500 down here on the monthly has broken into that moving average range, giving us a bearish indication, and the price is also pulling back as well towards those moving averages. Also, we've got this fair value gap that hasn't been filled yet, and very likely the price will come down around that area as well. Again, we don't trade based on those fair value gaps. You can see these ones back here were penetrated by these subsequent candles afterwards. Sometimes they can take years to play out, so don't go trading based on those. On the weekly, likewise, the price and the CCI broken into a downtrend below the moving averages. And if I zoom out, you can see there I've got a fair value gap up there which hasn't been touched, and another one, a small one down here, which if the price does continue down, it may possibly come down to there again. But we don't use that as a potential trading option. We do primarily with the CCI trends and the moving averages on the price as our primary trend. Now, in terms of the daily, again, you can see there that first of all, the price is below the moving averages, and so is the CCI, so taking only short trades. And what I've done here, I've marked here with arrows where you would have taken short entries based on the CCI and the price breaking below the moving averages. So you would have gone short in that period on the hourly time frame if you're trading the hourly or any other micro level, and you would have stopped and you would have closed out your trades, your short trades on that arrow there, on that candle, because the CCI broke into that moving average range. Now, you would have avoided going long there, and I'll tell you why in a second. First, let's go to the hourly chart. Again, taking short trades only. You can see here on the hourly, these are the areas you would have gone short from that point. These correspond with these arrows here. So you would have taken these short entries, and you would have stopped taking short entries once you started seeing that CCI turn up, and that was the latest you would have got out, according to the daily as well, at least. Now, you wouldn't have gone long during this period because number one, during that period there, that you can see there that was already in that moving average range. So theoretically, it's still somewhat neutral to bearish. At the latest, you would have got in around this point there if you were waiting for a long entry. The CCI was above the moving average, and so was the price. But notice that on the hourly chart, that corresponds with this area here. And what do you see? You've got this bearish divergence. Remember, always don't trade against the bearish divergence, or if you're going short, don't trade against the bullish divergence. So you've got declining peaks there, or lower highs on the CCI versus higher highs on the price. So that break above there on the daily was in contrast to this point here on the 1 hour time period. And seeing this bearish divergence, you would have avoided going along at that point. In which case, had you done that, you would have got in on that candle. That confirmed the downside when the price and the CCI broke down below the moving averages. And that's where you would have continued a short positioning. Now, in terms of the strategy we generally follow, this shows where the price breaks below the moving averages, in this case, according to the rules, below the price as well as the CCI. And up here I've got the back test for the stop loss approach and the back test for the average down approach. Now again, notice with each of these, with our three main rules that we follow, trade in the direction of the daily, close out your trade on the hourly if the daily hits the moving averages against you on the CCI, and on the hourly, stop or be cautious of the divergence against you. So here, if you're going short, if I zoom in here for a moment, you'll notice there we had lower lows on the price versus slightly higher lows on the CCI. That was a bullish divergence, and as soon as you notice that, you would have got out of the trade somewhere around on that point there, and you wouldn't have gone long nor short, because you wouldn't have gone long because you're still in a downtrend on the daily, and you wouldn't have gone short obviously because both the price and the CCI are rising. Now in this case, the back test, I've let it run continuously, and you would have got back into the short positions once the price and the moving averages on the CCI moving averages broken below again. Now, where are we at the moment? As I said, you would have started taking short trades again, but notice you would have taken your profits a couple of times. You might have got out with a small gain on that, or a break even on that trade there when the CCI broke into the moving average. Take another short entry there and close that out again on that one, another little gain. Go short again on that candle, the CCI breaks below, and you would have closed it out again on that candle there before the price started retracing back to the upside. Notice as well the CCI has already turned bullish there. The price is still in a downtrend, but again, only trading in the direction of the daily. So BOIL on the monthly, well below the moving average range, giving us a long-term bearish momentum. There's no CCI for it right there. Notice, however, we've got these fair value gaps that haven't been touched yet, so that's a very long-term play. Can't say when that's going to happen, but just be aware of those very long-term on the monthly. On the weekly, likewise, those areas are still untouched in terms of fair value gaps, but what we're looking at primarily at this point is the break below the moving averages of the price, and the CCI is broken to a downtrend as well. That was after giving us a bullish divergence, so the price did bounce after that bullish divergence, and then now it's currently in a downtrend and resuming that. On the daily, both the price and the CCI are in a downtrend. Again, there's those a different set of fair value gaps, so just be aware of those. We might see a bit of a bounce in the coming weeks or even months, but don't go trading based on those alone. On the 1 hour time frame, again taking short trades only, and you would have taken short trades from there, but notice, had you gone short there, you would have probably closed out your trade on that candle there. The CCI is broken into the moving average range, and notice here we've got a fair value gap, so the price may well bounce up into that range, coming towards that moving average up there, that moving average 200, to cover these fair value gap unfilled orders. So the KOLD is the inverse on the monthly. We've got a bearish divergence or bearish momentum at the moment below the moving averages, although the CCI is showing a slight bullish movement, so just be aware of that. Don't go short or long if you're trading on the weekly, but also notice these fair value gaps up there which haven't been touched yet, so that could be a long-term play again. On the weekly, both the price and the CCI are broken to the upside. Are they false breaks? We're not sure yet. I'd like to see that break a lot more convincingly and see these moving averages start trending upwards as well, like it did back here, for example. There's no fair value gaps that I can see there. On the daily, we've actually got a bullish momentum as well. The CCI and the price are above the moving averages, so taking long trades only. Looking at the 1 hour time period, again, break a big gap up above that point once the break above the moving average of the CCI and the price, and currently you'll be closing out your long trade on that candle because the CCI is touching that moving average band. Notice as well, that's a fair value gap between the high of that candle and the low of that one, so the price may well come back down and possibly break through that or even bounce off that range. So for UNG on the monthly, that's bearish at the moment, below the moving average. We did have a bullish divergence back here that bounced slightly, and now it's resuming on a downtrend with the CCI and the price breaking below the moving averages. The CCI is still in that mid-range, so not quite bearish yet. But again, notice up here we've got this fair value gap that hasn't been touched, so that could be an area to look out for a longer term. Again, it could take years to play that out. On the weekly, bearish on the price and bearish on the CCI, so bearish trades only to be taken. And we did have a bullish divergence back here, higher lows versus lower lows on the price. It bounced, and at the moment it's resuming a downtrend. On the daily, the price and the CCI both below their moving averages, so confirming short trades only if you're trading on the 1 hour time period. And there's no fair value gaps that I can see at the moment based on that. There is one actually here, if I covered that one. Let's do it to there. So that may likely bounce, the price may likely bounce to there in the coming days, possibly to fill those orders before continuing in a downtrend possibly. Now on the 1 hour time period, again notice we don't take in short trades only. Wait for the CCI to break below again to take short trades. And again, there's another fair value gap in that range there to be aware of. And the price may very well break into that range. Notice here we've had a couple of other fair value gaps. That one's they've been filled, and this one as well has been filled as well slightly with these candles. So again, we might see further decline, but just be aware we might see a bounce as well to fill those orders in the coming days possibly. So remember, if you haven't already noticed the +1 videos, keep an eye out for those. I'll put this one out today, including a Heiken Ashi backtest with table of results showing the results of that, how that compares to the CCI350 and the CCI14. And I'll continue to add to that list as we progress. Thanks, hit that like and subscribe button, and I'll see you in the next update.